record. I'm going to give you permission to record if you'd like to record for yourself.
Yes, please.
And there you go. Now you can record for yourself. Try and find 3.1 for me because I'd like to have the whole shooting match. All right,
Okay.
so 3.3. So as we said, the FINRA contract outline does make sense. What I mean by making sense, it does have a flow. You know, the test writing committee gets together and they say, Ashley, what are the functions of being a broker? Function 1 is, can you find a customer? Function 2 is, can you open an account? And where we're at right now is function 3, can you make an investment recommendation? Now, a lot of people, when they say, oh, that's a lot of suitability, I go, well, yeah, because suitability is based on the investment products and being able to know what would be suitable given somebody's, data profile, customer profile, which something would not. Okay, so required disclosures of specific transactions. The key word here is material. You know, material is a word that means might alter your decision. Something you ought to know. You know, I saw a broker being interviewed and he was asked why he didn't tell somebody this information about the investment. And he said, I thought I'd lose the sale. That is the all-time worst answer. I say, Ashley, it might alter your investment decision, but something you ought to know, you know, in a variable annuity, when you start withdrawing after you're 59 and a half, that's going to be taxed at ordinary income tax rates. And if you had Ashley put this money into a regular mutual fund and you held it for more than a year, you'd be taxed at capital gains rates. Now, that's something somebody should know before they're 59 and a half, right? There's no problem with that variable annuity. It's just, again, making sure the disclosure, right? Or, hey, Ashley, in this partnership, this is direct participation program, and it's organized as a partnership, and there's a general partner, and you're a limited partner, and you can't get in or out without the permission of the general partner. And this lacks liquidity. And you say, well, is that important? I go, yeah, that's a kind of a material kind of thing you ought to know. When I'm making disclosures to you, particularly in a, for example, a mutual fund, I say there is additional information available. So besides the prospectus, we have a statement of additional information. If you're interested, we're more than happy to send that to you. Here's this word again, material. When there's been a material current event, you know, then we have to file what's called an 8K. So if you're a publicly held company and your CEO resigns, or, you know, your publicly held company, there's some major lawsuit, you're going to have to file an 8K that tells your customers, your shareholders, what's going on. Control relationships. Keyword here, by the way, is also disclosure. I mean, you know, sunlight's the best disinfectant. So, you know, your default should always be we disclose things. I mean, you know, that's kind of where we should always be. But control relationships need to be disclosed, and there's a test question here as well. So if I'm a Merrill Lynch broker and I'm talking about Bank of America, I say, Ashley, have you been following the bromance between Brian Moynihan, our CEO, and Warren Buffett, the CEO of Berkshire Hathaway? Man, they really just think the world of each other. And Bank of America is the parent company of Merrill Lynch. And what I think you ought to do, Ashley, is buy 1,000 shares of Bank of America. And you say, well, Dean, you have discretionary authority on my account. I don't know why you're bothering me. When there's a control relationship like there is between Merrill Lynch and Bank of America, you can't use discretion. So 2 test questions here about control relationships. One is it needs to be disclosed. You need to disclose to you at Merrill Lynch that we are, you know, subsidiary of Bank of America. And then more importantly, we can't use discretion. I need your permission to make an investment in which there is a control relationship. So those are our 2 test questions about control relationships. Types of investment risk. Risks in the system. Systematic risk. Systematic risk is the tendency of securities prices to move together.
And it's also something you can't diversify away, correct?
Oh, I love that. That is so spot on. You know, the way we say that on the test, and you nailed it, is risk prevails despite diversification, right? So right on, right on. That is very much the test issue. Now they'll come at it from either side on your exam. What I mean by either side, risk prevails despite diversification.
Okay, so that's the
I
terminology.
think when it's when bad things happen to good stocks, right? The risk in the system of the market goes down 30%. I think your stock went down today too. Now, the other thing they test you on is non-systematic risk, also known as selection risk. Non-systematic risk. Yeah, and that you can diversify, right?
Yep.
Risk. Non-systematic risk, probably was good that together there, just AKA selection risk. There are 10 equally suitable ideas. I picked one of the 10, the other 9 did fine. The one I picked went under. And the easiest way to mitigate that is through diversification. Bernard Baruch said money is like manure and you have to spread it around. Otherwise it just, piles up and it stinks, right? So here, the easiest way test question for most people to diversify is in a mutual fund. So a couple test questions here, right? Now we do measure volatility of investments as compared to the market as a whole. So when we're talking about this idea of systematic risks in the system, we sometimes compare the volatility of an investment as compared to the market as a whole, the market represented by the S&P 500. Remember, we talked about that, I think, earlier, beta, right?
Yes, I was going to say that.
That's right. So if we're talking about a beta 1.5, that means it's 1.5 times more volatile than the underlying market, right? Reinvestment risk. Test question, and we do have an investment vehicle where you have no reinvestment risk. Reinvestment risk is the risk that when your bonds come due, that you can't reinvest at that same high rate, or even the coupons getting every 6 months. Every 6 months, you're confronted with, I got to do something with these things. And, you may not be able to reinvest at that same high rate. So first point is reinvestment risk is associated with a declining interest rate environment. And we do have an investment vehicle where there is no reinvestment risk. Your rate of return is locked in. You're not going to have to worry about getting paid every 6 months because you're not. And that rate of return we've locked into maturity. Do you know what that would be? If somebody wants to eliminate reinvestment risk, what is one of the arrows in our quiver? Test question, a zero coupon bond. A zero coupon bond, right? Because a zero coupon bond, you are not getting what? Any payments that need to be reinvested.
Okay.
So zero coupon bonds have no reinvestment risk.
Okay.
And, we have timing risk. That means you, instead of buying low and sell high, you sell high and buy low. And the easiest way to avoid timing risk is to, just buy and hold. Don't try and time the market. But, that's a risk as well. Types of investment return, very testable. If I have a client in an uncomfortably high tax bracket, they might be interested in tax-exempt interest. And boy, if you don't get this one right, Ashley, you should flunk the entire test on Monday. What kind of bonds pay tax-exempt interest?
Munis.
There you go, right? I mean, that's one of those ones I joke. I don't know about you. When I take a test, I like to get to the first question I know the right answer to. I go, all right, something on this test I know, right? So now remember, within that tax-exempt interest, there are a couple bonds where we have to determine suitability. What I mean by that is, if I'm a resident of New York and I buy a New Jersey bond, New York can and will tax me. So I'm going to know your residency. I'm going to use your tax bracket and suitability. And remember, we also had private activity bonds. We had those industrial development revenue bonds. We also had those public purpose non-essentials. And remember, those private activity bonds are subject to the AMT. So if somebody's seeking a tax-free a tax exempt interest, we wouldn't, I'd have to qualify them a little further. And if they tell me that they actually are subject to the AMT, I wouldn't recommend to them a private activity bond. And I wouldn't recommend to them a public purpose non-essential. What that is a stadium.
Okay.
And so it's a binary, people I think get hung up on this. It's a binary question. What I mean by that is they're just going to simply say they are or are not subject to the AMT. So this is taxable to investors subject to the AMT.
I did get a question like this on my exam, like
Well, there
who's
you go.
subject to the AMT, and I just said people that are in a tax bracket that qualify for AMT.
That's right. That's exactly right. But it basically, they don't get into the weeds about what it is, but it's basically you make over 200,000 a year and you start taking deductions. So for example, I'm coming to you from my studio here in fabulous Las Vegas. This is my office, this is a studio, and I can deduct it. Not if I'm subject to the AMT. Then they say, Dean, no home office deduction for you. The idea is to toss out things they know you're using to zero out your tax base so that people pay taxes. Now, we don't need to worry about, home office deductions being part of the AMT calculation. What we're going to do is say, try it again, and I'm going to owe some money. We're not worried about, oil and gas, intangible drilling costs being a preference item. We are worried about knowing that the interest on these bonds is going to be taxable. And then the technical word for that, these are preference items under the AMT, meaning things that become taxable. But if you're not subject to the AMT, well, then maybe it's a good deal for you. Maybe you can get a value here. All right. So tax exempt interest or return of capital. So, we get a lot of times focused a little too much on a return on your capital. And we lose sight sometimes of a return of your capital. Boy, I tell you, I can't tell how many investors make stupid, foolish decisions by saying, oh, Dean, this investment pays me 13%. I said, well, that's a return on your capital, but you should be concerned because maybe they default and then you never get it back a return of your capital. And you're going to get a loss. Now, we do have one investment that starts by returning, well, I should say two, but there's two we're concerned with. In almost every investment we do, we get a return on our capital, like a bond or a stock, dividend, interest. And in the bond at the end, we get a return of our capital. But we have two investments where you actually start from day one getting a return of your capital, a return of your capital. And those two are Ginnie Mae's, very testable, because remember, Ginnie Mae's pay interest and principal monthly. And then the other one is a direct participation program, a partnership. Because remember, in a partnership, you start getting distributions right out of the gate. The idea of a partnership is you get all your money back and then you're still getting money. I say, hey, Ashley, the partnership has returned all your capital to you. Woohoo. And now all the money is a return on. So partnerships start with a return of. Once they've given you back your capital, then a return on. Most investments, that's not how it works, right? But Ginnie Mae's, interest and principal monthly, partnerships, a return of capital. Cost and fees, so markups. By the way, it could be markdowns. But if we have a markup, that means you bought the stock from a market maker. And that means your firm is acting in a dealer principal capacity. And market makers mark up. That's called their asking price. That's what the market makers sell at. And then their marked down is known as their bid price. And what do we call the difference between the bid and the ask?
The spread.
The spread, indeed. And then remember, whether it's a markup or markdown, whether it's a markup or markdown, we do have a 5% policy. You know, here we're acting in our dealer principal capacity. By the way, very testable. I'm always going to explain to you capacity on your confirmation. I say, Ashley, here at Goldman Sachs, we are a broker dealer. And in some transactions you do with us, we'll be acting in our dealer principal capacity. We'll be charging you a markup or a markdown. Yeah, but in each and every transaction you do with us at Goldman Sachs, we'll disclose capacity, and we'll never be a broker and a dealer in the same trade. I'm going to be one or the other. And again, this needs to be disclosed. What capacity we act is disclosed test question on the confirmation. Now, if we're not a market maker in the security, that means we're going to get the security. If it's over the counter security, we're going to get that from a market maker. A good way to remember this is agent, broker, commission, disclosure.
It's ABCD.
ABCD, right? So firms like Fidelity, at Fidelity, we say, Ashley, at Fidelity, we are a broker dealer, but we never act in our dealer principal capacity. The only capacity we ever act in as your agent. So as your agent of Fidelity, we're going to go get that security from a market maker. We're going to be acting in our broker capacity, and you're going to owe us a commission.
Okay.
And that will be disclosed on your confirmation. And remember, we'll never be a broker and the dealer in the same trade, right? So commissions, whether we charge you a markup or a commission, we do have, test question, a 5% policy. That's not a rule. Policies aren't rules. Policies are for the guidance of wise men and women. And the 5% policy applies to secondary transactions. That's very testable. It doesn't apply to primary transactions. I give you a prospectus. 5% goes out the window. Mutual fund, remember the max is 8.5. We might do a net transaction. A net transaction is where I say, instead of buying it for you and charging a commission, Ashley, as I told you, I'm not a market maker, but the market maker's quote was 15.16. And so, what I did is I bought it at 16, not for you. So you don't owe me a commission, but I sold it to you at 16.01. I put a penny in there as a markup. That's a net transaction. You owe me 16.01. And you say, hey, Dean, why'd you do that? I said, well, it was easier for me to do that riskless principal meaning you're buying it from me now. But that's a penny on 100 shares. That's $1, and that's way less than my minimum commission. So, you benefit. By the way, it doesn't have to be that, but that, it'd be helpful if I had some reason about why I'm doing something, right? If I can articulate it. We have different share classes in mutual funds. Do you remember the share classes we have in mutual funds?
Class A, B, and C shares.
There you go, right? So we have A shares. We have B shares. And we have C shares. Now, again, this is not where we're going to start going over, calculations of NAV and POP and all that kind of stuff. That's different. Here we're going over disclosures about the costs and fees associated with investments. So, and here what we would say, Ashley, is A shares are good if you have a large sum of money and you're a long-term investor. And then different discussion, very testable, not part of what we're doing right here in 3.3, the idea of a break point and a letter of intent. And I think we talked about all that stuff and the backdated 90 days. And, that's a different thing than what we're discussing right now. Here, we're just talking about disclosures of what share class would be best given a circumstance. Now, as you recall, maybe you don't, I hope you do. The B shares have a contingent deferred sales charge.
Mhm.
And here again, we want to make sure we're disclosing to you, it's typically 3 to 5 years. We don't get into that, but this would be good, Ashley, if you have a smaller sum of money, but you plan on being in the fund for a longer period, because if you're in the fund for long enough, they'll waive that sales charge and your B shares turn into A shares. And again, it's a disclosure of the different share classes. Now, remember, the C shares typically have a 12B1 fee that never goes away. And so, maybe not appropriate for somebody who wants to be in this thing for a long, long time, because they may have been better just to pay the load and be done with it. In other words, we refer to A as front end load. And that may be, the better kind of idea for you. And I think we did talk about 12B1 fees when we talked about mutual funds. And for those 12B1 fees, there are in those 12B1 fees a cap. Remember how much I can actually, as a no load fund, have as a promotional expense and still hold myself out to the public as a no load?
I want to say 0.75, but I don't think that's right.
It's 0.25 for no load.
Okay.
But your point for the C share, the max, once you go past 0.25, you can't refer to yourself as a no load. But once you go past that, then it becomes 0.75.
Okay.
So, and if you're buying a variable product, the important part about a variable product is to say, Ashley, a variable product is a mutual fund with an insurance wrapper. I'm just making this up, but this is how I would explain it. If you're a compliance officer watching this video, we're just trying to pass the test. I know a compliance officer would have a problem with me saying a variable annuity is a mutual fund with an insurance wrapper, but that's kind of what it is. And I say, so that means, Ashley, that you're going to have the costs associated with the mutual fund, but you're going to have the additional costs of the insurance features, the mortality risk, right? An expense charge, that's frost me, Ashley, but I pay them to agree not to charge me more than X. But the expense charges are certainly a part of it. It's a higher cost product is what we're disclosing than a traditional open-end mutual fund, right? Soft dollar arrangements. So, as an investment advisor, whoever I use as a broker dealer for execution and custody is going to love me because, I do a lot of business. I think Fisher Investments is a good example. Fisher Investments, I don't know, let's say they got 500 billion and they don't have their own broker dealer. So, Fisher Investments uses, Schwab. I think they got like $100 billion at Schwab of their customers' monies and securities. And there's entire teams dedicated to servicing Fisher Investment advisory clients who are also Schwab broker dealer customers. And again, Fisher isn't monogamous. I'm sure they probably have another 100 billion there at Fidelity. And, and they tell clients at Fisher, hey, Ashley, we don't own a broker dealer. So if you don't want to use Schwab or Fidelity, if you got a broker you like at Merrill, fine. But, a lot of times investment advisory firms will call broker dealers and say, hey, I would like some soft dollar compensation for sending my customers your way. And the test question is, what can't a broker dealer pay for? Broker dealers are, perfectly happy to, give a soft dollar compensation to, register you for seminars or whatever. I mean, what a broker dealer can't pay in soft dollars as compensation to an investment advisory firm is rent, travel, or furniture. They can't pay for things that don't help the customers. Right. So, that's something I can't pay for. So if I'm a broker dealer and an investment advisor calls me and says, hey, Dean, how about some help with my rent this thing? I can't help you on that. Dean, hey, you registered me for the seminar using soft dollars, your broker dealer. I appreciate your broker dealer, Dean, paying for my seminar registration fee. I say, hey, not a problem. Hey, now Dean, I need an airline ticket and hotel while I'm there. I go, "Ah, can't do that for you. You're on your own for that part of it." Here are tax considerations. Now, here they don't really get into the dollar amounts that change all the time. For example, the gift used to be 15, this year it's 16.5. And they just don't want to have to continually update the thing. So what they do is they stay big here. They don't test you on like what is it this year in terms of the annual gift limit. I just told you it's 16.5, but what they do test you is on the cost basis of securities received as a gift or the cost basis of securities that were inherited. And do you remember what the cost base is if you get a gift of securities? So somebody gifts you securities. The one they like on the test, I don't know why they like on the test, a grandma and a granddaughter. I don't know why, but that's the one they like. And so
That's you're gifting it at the grandma's cost basis.
that's right. So Grandma Ashley gives granddaughter Ashley securities you assume her cost base. Right? Now, if grandma dies, then what happens? Grandma Ashley dies, and Ashley, Ashley, you inherit the securities.
You're gonna inherit the cost basis on the date of death.
Perfect. That's right. And the way we have a kind of a way we say that, it's kind of like learning a foreign language. They say when you dream the foreign language, that's when you know it. So that's called a step up.
Okay.
And the cost basis. I forget. I think you told me you're taking a 66.
After this, yes.
Yeah, and you're going to get that again. So there is some overlap. So I'm joking. The dead grandma question is on both the 7. It's on the 66. I don't know why they want to kill people on the test, but it is what it is, right? Market analysis. So, we have fundamental analysis and then we have technical analysis. And here we're interested in momentum. Is there upward momentum? Is there downward momentum? What is the market sentiment? We can base that on, various things, advances versus declines. We definitely have the indexes you're held accountable for. There's various market indexes. And one you should definitely be aware of is the S&P 500. Because the VIX, for example, VIX is known as the fear index, right? The fear gauge. And you can buy options on the VIX. And the VIX, sometimes they ask you what market index is the VIX based on. And you would say the S&P 500. Now, in your 66, again, this section that I'm going over with you now for your 7 on the 66 is a bigger deal. I mean, they will get a little more in the weeds on this. But options volatility. We said options have volatility like stocks, and what are people willing to pay for option contracts? And we can say if people are willing to pay more for puts than calls on the same stock, on the same strike, that would be a bearish indicator. And if people are willing to pay more for calls than they are for puts on the same stock at the same strike, that would be bullish. Market momentum. We're going to be talking here a little bit about charts. Oversold, overbought, that kind of thing. How much cash is on the sideline still? I mean, how much green ammunition's out there? I mean, because if we run out of buyers, then the stock market's going to stop going up and then it's going to start going down, right? So, we like to know like how much is sitting in money markets. Sometimes we refer, when you're watching like the news, they'll say how much dry powder is there out there? How much can we sustain that? We'll be talking about trading volume. Short interest is how much of the stock has been sold short. And again, we use that as an indicator. And one of the things we're tested on is what's called short interest theory. And theory isn't truth, it's just a way of explaining things. And it's kind of counterintuitive, but this is a bullish thing. So when short interest is high, it's actually a bullish indicator because those represent future buyers. So we know that if there's all these short sellers out there, that eventually they're going to have to buy to cover. And that will accelerate the bullish trend. So it's kind of counterintuitive, but what it's saying is that the short sellers can accelerate bullish trends. Because if the market starts going up, they're going to get squeezed. It's called a squeeze, not testable, but and then they have to buy to cover. That causes it to go further up, causing more people to buy to cover. And it's one of those kind of self-fulfilling kind of things. I wouldn't worry at all about index futures on the Series 7, but futures are kind of like options in terms of being derivatives. Market analysis or municipals. I haven't anybody tell me they've seen in a long time the bond buyer index in terms of a question, but it used to show up a lot. And the test question wasn't so much about the index itself, but where do you find it? And I would know that the bond buyer is a newspaper widely read in the municipal market. A newspaper widely read in the municipal market. So you are going to get tested on basic chart patterns. And one of the charting patterns that you're going to get tested on is the support and resistance. The support and resistance line. Now, so here we'll just make a support line. And here we'll make a resistance line. And we'll call this chart Apple. And we'll say this was 185. We'll say this is 195. So that is the trading range. And this is going to be time going this way. And boom, let's put that here. And this is going to be price going this way. And then what we typically do is we plot, the price each day, and then we connect the dots, and then we have a charting pattern. Maybe it looks something like this. Now there's our charting pattern. So test question number 1 is, what do we call that bottom line? What do we call the bottom line in this charting pattern? Support or resistance?
Support.
Support. And what do we call this bottom line? Or top line, excuse me.
Resistance.
And, if for technical analysis, we don't believe in buying stocks that are stuck in a trading range. We only want to buy stocks that are moving. So, in technical analysis, we're going to be using charts. What we're trying to determine here is the future price of Apple based on its past price performance. And so what we're saying is, I really don't want to buy the Apple stock unless it breaks through one of these lines. Otherwise it's dead money. So I either want it to break through the resistance line or break through the support line. I don't care just as long as it breaks through, because there's no need getting on board the train when it's stuck in the station. You don't want to get on board the train until it leaves the station going your way. So that's called a breakout. Who cares? What we do care about, test question, is what kind of order might a technical analyst place to establish a long position? So as a technical analyst, I don't want to buy this stock unless it breaks through this resistance line. So what kind of order would I place above the market to, go long if it breaks through?
I struggle with these.
Well, that's okay. That's why we're doing this, by the way. So this is Tesla, actually. So the whole point here, right, is to find you the points. We would place a buy stop.
I was gonna say a sell stop, so.
Well, that's why we're doing it, right? So a buy stop is used to establish a long position in technical analysis. So one use of a buy stop is to establish a long position. And remember, we don't want to buy it if it's not going anywhere. Please note, it's also very testable. Where did Dean place this in relationship to the current market price? I placed it above, right? So, here we're going to place it. Maybe, we're looking at our chart and we're going to place it at like 197. And that way, if the stock breaks through, I got my buy stop above the market, and now it breaks through. Boom, it triggers my order, and now I go long. Very testable. There are lots of people that have buy stops above the current market price. And so when the stock breaks through the resistance, all these buy stops get triggered. And that test question can accelerate a bullish trend. That can accelerate a bullish trend. They'll say, which of the following orders can accelerate a bullish trend? Because remember, technical analysis, it's all about the trends. I mean, that's the whole point of technical analysis, is to catch a trend. Catch a trend and you're sitting on top of the world. That's what you're trying to do, either an uptrend or yeah. So again, as a technical analyst, I don't care if it goes up or down, just as long as it moves. So what I might want to consider doing is placing an order below the market, below the support line, to go short. And what kind of order would that be?
Sell stop.
Yeah, very important to know that sell stops are below the market. So maybe I put my sell stop here at 183. Now below my support line. And again, now what I'm looking for is to see, okay, what happens now? I'm telling my broker, if it trades at or through 183, trigger my sell stop, turn to market. He goes, well, Dean, you don't have the stock. I said, I know I don't have the stock. And you go, well, Dean, if you sell the stock and you don't own it, you're going to be going short. I said, well, that's exactly what I'm trying to do. I'm trying to establish a short position. So that's one of the uses of a sell stop. Now, a lot of people have sell stops below the market. So when it trades through, it triggers all these suspended orders become live, and sell stops can accelerate a bearish trend. So buy stops can accelerate a bullish trend, and sell stops can accelerate a bearish trend. All right, so charting patterns we're held accountable for. Another charting pattern that we're held accountable for is a head and shoulders pattern. Head and shoulders is not a shampoo you use to take a bath in the stock market. Head and shoulders pattern, test question, is a signal of a reversal. A signal of a reversal. And a head and shoulders pattern I'm showing you here, this one, test question, is the end of the bullish trend and the beginning of the bearish trend, signal of a reversal. Well, we have two versions of this. We have two versions of a head and shoulders pattern, right? And the two versions we have is this version of a head and shoulders. But another version of a head and shoulders we have is what's called an inverted head and shoulders. An inverted head and shoulders would be, again, a signal of a reversal. And this one would be the end of the bearish trend and the beginning of the bullish trend. So we have two versions of these head and shoulders. We have the regular head and shoulders, and then we have the inverted head and shoulders. And we said breakout is good. That's what we want. We talked about the resistance. moving averages just even out my chart, makes it less pointy. And by evening out the movement of my chart by doing what's called a moving average, it just makes it easier for me to interpret whatever the charting pattern is that I'm looking at. Overbought and oversold. So again, overbought means we think the market's going to drop because we're running out of buyers. And so overbought again would be a negative indicator. It means, remember this idea of there's not much many more people to come in behind me, right? To buy what I'm buying. And then oversold would be bullish, because that means there's going to be people coming off the sidelines because too many people have sold it. So overbought is bearish and oversold is bullish. And then material events, we talked about disclosing any kind of a material event and whatever we're trying to get people involved in. Communications about account information, processes, requests, and returning documentation. So we talked about customer confirmations, and we said one of the biggest things on the customer confirmation is disclosure of capacity. Whether we acted as a broker or a dealer in the trade. Very testable. How often do you get statements? So you get a confirmation for any transaction, and that will disclose capacity. And how often do you get statements? Quarterly. You are correct. However, there is a circumstance in which you would get a monthly statement.
Penny stocks.
Right on. If there's a penny stock in your account, we're going to give you a monthly statement. And then Ashley, what is the definition of a penny stock?
A stock that's $5 and below.
Yeah, it's a non-NASDAQ OTC stock under 5. Right on. Right on. Now, what's going to be on your statement? We're going to give you the account value. We're going to give you profits or losses. Realized, now that's an important word. Realized means on the statement, we're showing you the sales proceeds. So remember, you have cost basis. That's when you turn your money into the investment. And then when you turn the investment back into money, that's called your sales proceeds. And so we'll show you the realized gain or loss. And remember, at the end of the year, that's going to be very important about the realized gains or loss, because that's what you're going to owe taxes on, right? So we're going to net all that out. And then unrealized, we're going to show you the positions that you haven't closed out that are open positions in your account and what those are presently valued at. Unrealized meaning you haven't closed out those positions. You still have your cost bases, but you haven't yet received any sales proceeds. By the way, what I'm kind of hinting at, and now I'll stop with hinting, is that this is going to be taxable or have tax consequences. This idea of realized gains or losses, that has tax consequences. Whereas unrealized have no tax consequences. Larry Ellison looking at his brokerage account statement that shows he has $100 billion in Oracle stock is not taxable. What's taxable is if Larry decides to do what with the stock? Sell it, right? Realize that. This drives my progressive friends. I'm not a progressive, God knows, but I have progressive friends. And they don't like the idea that all these very, very wealthy people never realize any tax consequences to their securities because they never sell them. They just, they just hold them forever and ever and ever and ever and ever. And then, their heirs hold them forever and ever and ever and ever and ever. Right. So, I think who was it? Was it Sanders, Bernie? Was it Bernie or Elizabeth Warren? They were talking about having a wealth tax where we would force people to have to sell X number of their securities. So that there would be some taxes that would be brought in from doing that. I think that Elon made a good case. He said, listen, I paid my share. I sold $9 billion worth of Tesla stock this last year. And I paid huge amounts of taxes on the capital gains. P.S. I mean, I don't feel sorry for him either. It was stock he got from Tesla originally that he owes the taxes on. Withdrawals and tenders. So again, we were going to disclose to you any tender offer made to you. A tender offer. So I say, Ashley, the reason I'm communicating with you today is we have received a tender offer on your stock. Would you like to tender your stock to the acquiring company? They want to buy your stock. And you said, well, what are the terms? I said, they'll give you $20 a share, or they'll give you 2 shares of their stock, whatever that is. And that would be disclosed to you. And, typically tender offers open for 20 days. Or I might say, hey, Ashley, the company itself is tendering for the convertible bonds that are in your account. And do you want to tender those bonds, or do you want to turn them into the X number of shares of the stock? Right. So that's what a tender is. If you want to withdraw money from your account, very testable. We only cut checks to the title of the account. So anytime somebody wants to get something out of an account, they say, Dean, I would like to withdraw 50,000. And I know the account is my joint account with my wife, Mr. and Mrs. Smith, but I'll just cut that check to me, Mr. Smith. We've discussed it. And, I'm going to be doing what we agreed to with the 50,000. I said, well, listen, I hate to break the news to you, but no, if that account says Mr. and Mrs. Smith, that check that represents a disbursement or withdrawal will say Mr. and Mrs. Smith. However accounts are titled, that's how checks get cut. Now, when you open an account with us, we need a physical address. After you open the account with us, we'll send things to a PO box, but on the original documentation, we want a physical address. And if you move, we'd like you to update that. Now, anytime there's an update made to a customer account, we're going to send out a notification to the customer that the address has been changed, just to make sure it's them, right? And that's not somebody who's, sending it to themselves or, doing identity theft, whatever it is, right? Required notifications would be, by the way, we do this when you open the account, we do it every 36 months. It will trigger to send it out to you and say, hey, please check our records, make sure all the stuff we got is correct. Your investment objective. For example, if all of a sudden you change it from safety principle to speculation, I say, I wonder if that's Ashley or if that's a broker that's actually doing that. So we send it and say, Ashley, did you change your investment objective from safety or principle to speculation? That's kind of odd. Now, to get too in the weeds on books and record retention, I would know ACATs. I would definitely know that. So if you leave your own broker dealer under ACATs, there's going to be a transfer instruction form. And very testable. How long does the old broker dealer have to validate the positions, to validate the accounts? So I'm broker dealer A, you're my customer, and you're leaving me to broker dealer B. Now, by the way, you probably can guess that it's not on my A1 to-do list priority to send your account to broker dealer B. Of all the things I got to do today, that's not a big one on my list. If we didn't have this rule, I've never transferred accounts, right? Oh, I'm working on it. I'm working on it. So we have 1 business day to allocate. Very testable. 3 business days to transfer. Right. That's okay. Choices are 2, 5, 2, 3, 4, 6, lifetime. My question to you, Ashley, is 2 years, 3 years, 4 years, 5 years, 6 years, lifetime. What is the record retention for the vast majority of brokerage firm records? What is the record retention for the vast majority of broker dealer records?
Lifetime?
3. There are very, very few lifetime records of a broker dealer. The vast majority of broker dealer records are 3 years. So on your test, if you're not sure how long we're going to keep something, you're going to say 3. And you're going to be right the vast majority of times. Now, lifetime records are very few, and good news, I have a mnemonic device for lifetime records of a brokerage firm. Spam. So those would be lifetime records of the broker-dealer. So the S is stock certificates. Now, we don't mean stock from the customers, we mean the ownership of the firm. So if you're A.G. Edwards and you've been making investments since 1887, this is what we need from 1887. You say, well, we're a partnership. I say, okay, well, smart ass, give me your partnership agreement. I'm joking, but right, Edward D. Jones is a partnership. And so who are the partners? Makes sense. We want to know who the owners are, whether they be shareholders, stock, or whether they be partners, because there are people who have been barred from the securities industry, and we want to make sure none of them are involved. Articles of incorporation, minutes of directors meetings. We want to know where there was a fork in the road and you took the road less traveled, because we want to pass a rule and say next time if there's a fork in the road and you can go left or go right, you're going to go left. Right? Very embarrassing if we name the rule after you, like the Drexel rule. That's embarrassing to get something named after you. Like, hey, I'm Ponzi. That was my idea. No. All right, let's go back now to the other side, 2-year records. If the record is less than 2 years, we have what's called ready access. I wouldn't worry about this on the test at all. But examiners love this. Hey, Ashley, it's 1 o'clock. I'll be back tomorrow, 1 o'clock. I expect you to have that record. So records within 2 years have to be really accessible. Wouldn't worry about that at all. 3-year records, I would worry about. The vast majority of brokerage firm records are 3 years. If I started now, Ashley, listing 3-year records of a broker dealer, it would be 5 o'clock before Dean would be done. There are very few, only 1 4-year record. So what I'm suggesting is we memorize 4, 5, and 6. And then everything else we're going to put in the bucket called 3. So you know what one of our 4-year records is? Test question.
Customer complaints.
Excellent. You are correct. That's it. Period. Full stop. Do you know what our 5-year records?
U4s and U5s.
What's that?
Your U4 and your U5.
Anti-money laundering.
Okay.
So that would be SARS and CTRs. Suspicious activity reports and currency transaction reports are 5-year records. You brought up a U4. The vast majority are 3, but U4s have to be amended within 30 days. I think of 6-year records as items of original entry. And again, I wouldn't get too in the weeds on this 7 because, this is actually somebody else who's doing this. But, 6 years, if I think you're cooking your books, I'm going to ask to see items of original entry. So this would be like the blotters of the stocks we bought and sold each day. I mean, you could fake that, but boy, it would take a little more work, right? The general ledger, for example. Right. The stock records. Now, I don't mean the stock of the owners of the firm. I mean that of our customers. The stock certificates customers send us and the stocks that we send them. That's called the stock record. And then, it makes sense that customer account statements and things like that are 6 because arbitration is 6. So customer statements. And if you leave me, I'm going to keep it for 6 months, or 6 years, because I don't want to go to arbitration and you have a record that I don't have. Right. So these are very few. Like I say, the vast majority of brokerage firm records are
3 years.
3. Yep. So that's where we want to be most of the time. Account disclosure procedures. So again, if you close your account, we're going to keep the record of that for 6 years, because I told you the arbitration is 6 years. So when customer closes the account, we're going to keep that 6 years. And then remember, the other thing we have to have in our written supervisory procedures, and this is called, and it's testable, the CIP, customer identification procedures required under the Patriot Act. And if you can't verify who somebody is, remember this with a picture ID, then I have to have how I'm going to close out accounts when I'm not able to verify a customer's identity. All right, that is function 3. The biggest part of function 3 was 3.2. And now what happens after the trade? So remember, function 1, find a customer. Function 2, open an account. Function 3, make an investment. And now function 4 is what happens after we make the investment. So this is where we find our types of orders, things like that. You know, we're going to go over some of these types of orders and quotes and all that kind of stuff. All right, so provides current quotes. We consider when we're looking at like a bid and ask that it's kind of a current quote. I mean, orders, offerings, and transactions and customer accounts at advertised yields. So, if we're going to have an offering sheet of bonds that we have in inventory and that we're willing to sell to customers, we're going to advertise the yield to worst. Where that's going to be either yield to maturity or yield to call, depending on whether the bond's priced at a discount or a premium. Types of securities quotes, all quotes are considered firm for at least 100 shares. So, if I'm a market maker and you call me and say, Dean, what's your quote? I say my quote is 15.16. That means I'm willing to buy that into my inventory at 15. I'm willing to sell that out of my inventory at 16. And, I might be displaying size. I have to be good for at least 100, but maybe I say I'm good for 8 by 7. So what that means in English is I'm willing to buy 800 shares into my inventory at 15, 8 round lots. And I'm willing to sell 700 shares out of my inventory at 16. You're an order entry firm. And you say, Dean, we're buying 700 shares at 16. And I say, I changed my mind. Test question. A market maker fails to honor a firm quote. Failing to honor a firm quote is a prohibited practice. It is a prohibited practice. Test question. Known as
Walking away.
Yeah, backing away. Close. Yeah, backing away. And you say, Dean, are you backing away? I say, yeah. What are you going to do about it? It doesn't do you any good to know that I've done something wrong and not know what to do. The other choices in the answer set will be like front running. That's bad. It isn't backing away, though. Front running is straight ahead customers. That's bad. Right. There'd be, painting the tape. Those are all bad things, but it isn't this one. Right. So when you have a trade practice complaint, the place you go under the code of procedure is FINRA's Department of Enforcement. And so, you say, Dean, well, I'm going to contact the Department of Enforcement. So never mind your fill. Now, on the other hand, you ask me what my quote is. And I say, I think I'm trading at something at like 15-ish. Well, that's not a firm quote. You say, well, Dean, get your butt in your chair and give me a firm quote. Subject means subject to confirmation. And that's like I say, I'm trading it at, or I'm coming back from lunch, Then you say, well, no, I want a firm quote. A firm quote is when I give you a bid, I give you an ask. All right, so let's see how you do on this. Let's call these choices here. Let's just label these choices and boom, let's get a color here. Let's call this choice A. Let's call this choice B. Let's call this choice C. And I say A, B, or C. Your customer wants all of the securities in one execution or none of the securities, but is willing to wait. That would be all or none. Now, all or none means I want all of it. Buy 1,000 shares at 16. I said, well, actually, right now the asking price is 16, but there's only 700 shares there. And you're telling me you want 1,000 shares all or none. So we'll see if we can do that for you. And, you said, what's going on? I said, well, actually, right now there's not 1,000 shares available there, but you're willing to wait. You say, Dean, buy 1,000 shares, fill or kill. It's a kill, right? Because as a buyer, I'm going to match you with a seller there at 16. I say, sorry, Ashley, there isn't 1,000 shares there. There's only 700. So it's a kill. So fill or kill, like or none. I want it all, but I am not willing to wait. I want it all and I want it now, right? Immediate or cancel. You say, Dean, buy 1,000 at 16, immediate or cancel. I said, well, I got a report for you, Ashley. You bought 700. There is 700 shares there. So immediate or cancel, like fear to kill, you want it now, but you are willing to wait. You are willing to wait. Now, the New York Stock Exchange test question can best be characterized as an auction order-driven market. Very testable. No, the New York Stock Exchange can best be characterized as an auction order-driven market. At the New York Stock Exchange, they're not trading against you. They're just matching buyers with sellers. Right? Less shenanigans. I'm not saying there's no shenanigans on the New York. I'm just saying there's less of them because there's what we call a designated market maker in the New York, who's charged, the designated market maker, formerly known as a specialist, who is charged with maintaining a fair and orderly market. Listen, in the over-the-counter markets, there's nobody who's charged with maintaining a fair and orderly market. I mean, the NASDAQ guys would like an unfair and disorderly market just as long as they came up on top. And so, that's one participant on the New York Stock Exchange. Another participant on the New York Stock Exchange is what's called a floor broker. And a floor broker executes orders for clients of member firms. So, if I'm the Morgan Stanley floor broker, I execute orders for clients of Morgan Stanley. Right. And so depending on who my floor broker is, will depend on whether this is a good idea. But first test question is, who has a market not held order? A market not held order is held by the floor broker. And this is where I tell my floor broker to go into the crowd, the auction, but don't tell anybody he has my order. And do it at whatever time and price, at whatever time and price. So I'm saying do it at whatever time and price you think looks good. So I said my floor broker, buy 10,000.
In. Dean, are you still there? Dean, I think you froze on me. Dean? What is that? Dean?